हेलो फ्रेंड्स, वेलकम बैक टू माय चैनल। तो आज हम लोग बात करने वाले हैं कॉरपोरेट टैक्स रिफॉर्म के बारे में। तो चलिए शुरू करते हैं। द जॉइंट स्टॉक कंपनीज, मोर पॉपुलर एज कंपनीज और एंड कॉरपोरेट सेक्टर इन इंडिया, पे अ डायरेक्ट टैक्स नोन एज अ कॉरपोरेट टैक्स, CIT, popular as corporate tax, on their annual profit. To existing rates used to be 30% for the domestic and 35% for the foreign companies operating in the country. Following the ongoing process of corporate tax reforms, the government in September 2019 affected a major change in the CIT, and the change, which was enforced from the fiscal year 2019 and 20, is briefly summarized below. For the existing companies with gross turnover 400 crores, the base corporate tax was cut from 30 to 22%. Thus, the effective rate, that is inclusive of surcharge and cess, fell from 34.61 to 25.17%. Companies can opt for the new tax rate by foregoing the deductions and exemptions availed by them, and this will benefit 0.9% of the companies, that is large ones, operating in the country, their number being 4698. For the new manufacturing companies with gross turnover below 400 crores registered on or after 1st October 2019, the rate was cut from 25 to 15%. In this case, the effective rate of tax fell down to 17.16%, and this will benefit 99.1% companies, that is small and medium ones of the country. This drastic move was aimed at three major objectives. Firstly, boosting the production volume of the manufacturing sector, which involves a large number of MSME, including the newly launched startups. Secondly, attracting higher investment in manufacturing industries. And thirdly, creating more job opportunities. The rate structure was left unchanged for the foreign companies. Logic behind the reform: in recent times, the corporate tax was cut by many countries across the world to attract investment and create jobs. India's move was an immediate response to great cuts initiated by Asian developing countries, which compete with India in the global export markets. After the reform move, the corporate tax rate in India, for few new manufacturing companies in particular, is lower than most Asian countries. And this is the list for the Asian countries and tax rate. Timor 10%, Singapore 17%, Brunei 18.5%, Vietnam 20%, Thailand 20%, Cambodia 20%, Malaysia 24, Laos 24, Myanmar 25, Indonesia 25, Philippines 30%. Other than attracting investment and enhanced job creation, the move is also expected to have a multiplier effect on the economy, increased income levels, and higher tax collections in the medium to long term. Let's talk about the dividend distribution tax. The ownership of joint stock companies, that is the limited firms, rests in hands of their shareholders. That is a part of profit to their shareholders once they book operating profit. The dividend paid, distributed by the companies to their shareholders, used to attract a direct tax in India known as the dividend distribution tax. It means before a dividend is to be paid to the shareholders, the DDT was to be paid to the tax department, that is known as payment of DDT in the hands of companies, and the rate of tax till March 2020 was 15%. Starting with the financial year 2020-21, and the government affected a major change in regard to the DDT. Now companies don't need to pay this tax anymore. The joint stock companies will transfer the dividend directly to the shareholder without deducting the tax. And this way, the dividend earned by shareholders will be part of their proposal income, which will attract personal income tax in place of dividend tax. It means dividends will still attract the direct tax, that is individual income tax, in the hands of recipient in place of companies which used to pay DDT, but still it will make a revenue loss to the government as the tax will don't apply with a flat rate of 15%, but rather get paid as per the income slabs of recipient. The change is estimated to entail a revenue loss of 25,000 crore annually. Experts and shareholders used to argue that the DDT resulted in increasing the tax burden for the investors who already pay an income tax, that is CIT, on their annual profit, and this is used to pinch those investors who are liable to pay tax less than the rate of DDT if the dividend income is included in their personal income. As personal income tax has various slabs for the non-availability of credit of DDT to most of the foreign investors in their home country resulted in reduction of rate of return on equity capital for them. The move is aimed at making the Indian equity market more attractive for investors, domestic as well as foreign. This move is supposed to provide a channel to the Indian population to be part of formal process of wealth creation in the country besides routing investment in nation buildings. Tax inversion versus transfer pricing. Tax inversion. This is a situation of tax structure, and this takes place when a firm base its headquarters in a low tax country while keeps its material operation in the high tax country, generally their country of origin, and this way firms cut their tax payment liability, and this is legal as is method of tax avoidance. Multinational corporations keep doing this. Several MNCs of the US origin shifted their headquarters to the UK during the 1970 1980. The country in the world which have very low tax regime for corporations have emerged very attractive locations for the headquarters of big corporations. Bermuda, Virgin Island, that is are such countries popularly known as the tax havens. Transfer pricing, a term of international economics via which an MNC charge lesser prices for its exportable to its arm in another economy where tax rates are high for increasing income. The East India Company did it heavily in pre-independence India. Base erosion and profit shifting. Base erosion and profit shifting is a kind of corporate tax planning under which the multinational companies shifts their profit from higher tax countries to lower tax countries, eroding the tax base of the higher tax countries. In practice, companies make profit in one country and shift them to other which has lower tax rate and take advantage of lower tax payment. And this way, companies don't pay tax to the countries where the profit is made. As per the OECD Organization of Economic Cooperation and Development, developing countries which heavily depend on corporate tax have been losing conservatively 4 to 10% of global corporate tax revenue annually. Tax havens. Tax havens are countries or territories or jurisdictions with attractive tax or financial rules for non-resident investors. They also provide secrecy or protection for investors, financial information, and require minimal local presence. In a sense, they are paradise for those who want to escape high tax countries. And the British Virgin Islands, Bermuda, Guam, Taiwan, and Jersey are some such countries in the world today. However, such locations have caused concern of illegal tax avoidance and money laundering. Equalization levy. India became the first country in the world to impose a tax on online services offered by non-resident entities which operate through subsidiaries with no permanent establishment in the country called equalization levy, and the direct tax was enforced in 2016 with the following features. applies on online marketing, digital platforms, selling goods and services, cloud computing, web designing, hosting and maintenance, online downloaded software and application, imposed with 6% rate on payment exceeding 1 rupee lakh annually. 1 lakh rupee annually. The Indian clients purchasing or taking services need to withhold this tax. The tax resolved the issue of base erosion and profit shifting by multinational companies operating in digital economy to some extent. Last topic है countervailing duty versus anti-dumping duty. Countervailing duty is imposed by the importing nations on imports if the export nation is found to offer export subsidy to their exports, and this measure aims at balancing the price of imports with the domestic products, and this duty is imposed in such a way that the imported item also remains competitive. A similar duty with the same aim once imposed by the importing nation in case of exporting country is found to export at below fair market price. It means the export nation is dumping the item in the operating nations. Importing nation is known as the anti-dumping duty. Both the duties are imposed after fulfilling the proper provisions of investigation conducted as per the specification of WTO. And this is done for the today. We will talk about the next topic tomorrow, and keep watching my video. Thank you so much.